All right. We are back to all my future millionaires out there. We're dealing with technical analysis, but specifically we're dealing with consolidation today. We're going to keep this short. We're going to keep this simple because this could be very simplified. It does not have to be complex, but I want you guys to get used to understanding what consolidation is. I want you to be able to identify it when you see it on your computer screens, on your phones, and I want you guys to be able to capitalize off of it. So when we talk about trending phases, it's pretty simple. We talk about uptrends when price is moving upward, when we talk about downtrends when price is moving down, and consolidation when it's moving sideways. This is more of your inconsistent movement. You know, price doesn't know whether it wants to go up or whether it wants to go down. So it's like stuck in like this stale state where it's almost like confused, but we know at some point in time, it's going to break out going back up or it's going to break out going downward. But this is what an example of consolidation looks like. I almost want you guys to think about it like just think about being in your house if you have small ceilings or ceilings that come low. And just think about bouncing a tennis ball back and forth from one side of the room to the other side of the room. And it's bouncing back from the ceiling to the floor, ceiling to the floor, ceiling to the floor, ceiling to the floor. Ultimately, that's what consolidation is. So as you see this consolidation right here, this is what you see. It's hitting from the floor to the ceiling, from the floor to the ceiling. Well, midway back to the floor to the ceiling, to the floor to the ceiling, from the floor to the ceiling. So we want to be able to clearly see where are our floors and where are our ceilings. So of course that's going to come from our markups. So some people just use basic markups when you're dealing with consolidation. Let's see, they'll just do one ceiling and one floor. Yeah, y'all know I like the colors. But the more advanced level of markups when you're dealing with consolidation, I like to add another floor and another ceiling, because sometimes your floor isn't, you know, as accurate as it could be, or your ceiling isn't as accurate as it could be. So I like to add what we call safe zones and aggressive zones. So let me show you what that looks like. So I'll add that here and then I'll explain it to you guys. Let's see, then I'll add that right there. Okay, so what we see here, let me move this out of the way. What we see here is the lowest low, my lowest floor, which is my support. That's my safe. That's my safe markup. That's my safe level of resistance. The highest high of resistance right here. That's my safe level. That's my safe level. This is what we call my aggressive level. This is what we call my aggressive level. And this is just, this right here is just a zone in between. This is a zone in between. So ultimately we're saying that, hey, nothing is guaranteed. There is no perfect setup, but it's about probabilities. So I'm saying with my safer markups, you know, if price reaches down to my safer markups, you know what, I'm a little more confident. I'm a little bit more comfortable with jumping in right there. But we do know from our markups that, hey, it could touch what we call the aggressive zone and it could leave us right there. So I have to make up in my mind, and this is where your own decision making is going to come into play. Or do you want to play off of only the safe zone or only the aggressive zone, or do you want to play off of both? Or do you want to play off of the zone in the middle? You know, or do you want to play off of all of those? But the main thing is understanding, number one, are you going with the trend? Meaning, yes, it has flowed into a state of consolidation, sideways movement, but what state did it come out of? What state of a trend did it come out of? And as we see, well, let's look at a more broader view of price so we can really see this. Price was coming in a downtrend. It was coming in a downtrend, and then it fell into this state of consolidation. So idealistically, you want to take puts. 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 Why? Because more of the momentum is pushing downwards. If you're trading a live currency pair, more than likely that second currency pair is stronger. So you want to flow with that second currency pair, which would be Chef. So you want to be taking puts idealistically. Now, within states of consolidation, you can take calls and puts. Now, I would recommend that for my more advanced, more experienced traders, my traders that have practiced such, that are used to such. And if you choose to take calls and puts, I would suggest that, hey, let's say, for example, if I'm taking $10 order sizes on my puts going along with price, then I may only take like $3 calls because now I'm going against the trend. I'm going against the bigger trend, because we know at some point in time price is going to break out and it's going to push downward out of this. But when price gets caught up in a phase of consolidation, we know it usually just going to happen for a little period of time. So we want to be able to capitalize and catch a couple of good clears off of price while it's figuring out whether it wants to push up or whether it wants to push down. So you must also, as we talked about before, decipher how much time I need to be putting up on these order sizes. So what do we see right here? This looks like a good 2.5 minute play. 2.5 to 3 minute 3 minutes on this play will get you out of there. And you want to jump in at either your highest highs or your lowest lows. Sometimes your highest highs may be represented by your aggressive zone. Sometimes it may be represented by the safe zone, the safe markup. Sometimes it may be represented kind of in that middle. So you're going to have to use your instincts and you're going to have to decipher such. So sometimes you can kind of look in the near past to decipher, hey, okay, where has price been stopping? Where has price been stopping? So I can start to anticipate the probability of where price could stop and where I should jump in, where I should jump in, where I should jump in, where I should jump in on price. Another thing that's going to really help you within states of consolidation, you really want to look out for wicks. Wicks can be very helpful. Usually when I see, price hit his head on the safe zone, or the aggressive zone, or in that middle zone, and that next candle opens up and we start to see a wick like you see here, that's usually an indication that it's go time. As you can see here, that's usually indication that it's go time. As you can see, even though that's a little wick, that's usually indication that it is go time. You see wicks here, that's go time. You see wicks here, that's go time. You see a wick, that's go time. You see a wick, that's go time. Now, I'm not saying that means that things are 100% certain, because remember, nothing is perfect in trading. Nothing is 100% certain in trading. You cannot just say, oh, because I see that wick, now it's time for me to over leverage because I just know. No. That is a cardinal sin. We're dealing with probabilities. The wicks on top of the other different variables that I named, or other different variables that you may cling to, just give us a higher probability in our mind that things may do a certain thing. But we know, again, at some point in time, price is going to break out. So we must be prepared for that. That's why we never over leverage. And that's why we never look at things in a light of certainty. We don't do it. We don't do it. We don't do it. We want to create disciplined traders within our ecosystem. So you have to stand firm on these principles. Another thing as well, too, within trading consolidation, just like trading any other trending phase, you want to be aware of the EMA. You want to be aware of the 200 EMA position on the 1 minute, on the 2 minute, on the 3 minute. You may even check, if you're on pocket options, you may even check the 30 second, the 15 second, the 10 second. You want to know where EMA is according to market structure and price action. Why? Because as we know, the EMA works like a magnet at times. We look at it like a magnet, and it could start to pull price. So you also want to factor in, where is that EMA before I decide whether I'm going to take calls, whether I'm going to take puts, whether I'm going to take both, or if I'm even going to play off of this phase of consolidation that I'm seeing according to what the EMA is saying. Sometimes you may say, I'm just going to completely stay away from this pair because I don't like how on the 5 minute, the EMA is below price, and on the 1 minute, the EMA is above price. I don't know if I want to play that. Or some people may say, you know what, that's perfect for me because it's above on one time frame and it's below on another time frame. It's just pulling back and forth. It's just pulling back and forth. But how you'll be able to verify that is what you see in past, in the near past. Is the near past showing you an inclination of what you think price could do? But also understand that with the EMA being underpriced on one time frame and it being overpriced on one time frame, it could pull towards one of those EMAs at some point in time. If we have multiple time frames where the EMA is under on multiple time frames or over on multiple time frames, price could eventually pull towards that EMA. So you could choose to leave it alone, or you could choose to use that in your advantage. But I just say manage your risk, manage your risk, manage your risk. Usually when I trade consolidation, usually I like to trade looking at the 1 minute or the 3 minute, but I used to trade off of the 5 minute. It's just all a matter of what's comfortable to you. I would suggest for you guys in your early stages to look at the 3 minute, look at the 3 minute chart, look at the 5 minute chart. It gives you a more clearer view. Sometimes you may say, you know, let me look at the 1 minute, let me look at the 3 minute, let me look at the 5 minute, and which shows more clear consolidation, whichever time frame that I want to choose that makes the consolidation look easier to my eyes, that may be the time frame that I want to trade off of. That's why anytime I'm looking for a pair to trade from, I'm looking through different time frames. I'm looking through different time frames to see on what time frame do I see more consistency in candles, red, red, red candles, more green, green, green candles, consistency. It doesn't have to be perfect. You see, it wasn't perfect right here, but I'm looking for consistencies like this on a pair to say, okay, that's the time frame that I'm going to be watching it on my pocket option broker or on my trading view, because it looks more comforting to my eyes. And lastly, as I said, you know, as I mentioned before, at some point in time, price is going to break out and it's going to leave you. This is why you don't over leverage, and you want to always anticipate, you know, price breaking out and price leaving you. You want to be able to anticipate that. And that's why the smarter bet, if, hey, like I said, we've come from a hard downtrend into consolidation, why you want to play puts, because call is eventually going to break out and leave you. It didn't do it here. Call is eventually going to break out and leave you. It didn't do it there. Call is eventually going to break out and leave you. It didn't do it there. Call is eventually going to break out and leave you. It did it right there. So just always be mindful if you're trading those live pairs, like I said, to be mindful of the currency strengths and the shifts within strengths, because that's going to tell you something about how to trade consolidation as well too. That's going to be another variable that's going to help you with, you know what, okay, so I'm looking at my currency heat wave, or I'm looking at my the currency strength website, and it's telling me that Chef has like 6 bars and NZD only has 1 bar. You know what? That's telling me that, you know, I have a higher probability when putting in these puts, because Chef is so strong, it should help to really pull price down. It should help to really pull price down. It should help to pull price down. But understanding the state of consolidation, because it is consolidating, even though Chef may be much stronger than NZD, price can still pull upwards. Price can still pull upwards. Sometimes I even choose to play consolidation when the currency strengths are even. They may be even on the website. They may be even on currency heat wave, and I'll still choose to play consolidation, because again, that's price being confused and it's just moving up and down. It's moving up and down. So you just play price until it leaves you. If I'm playing consolidation when the currencies are even on the live currency strengths, then more than likely I'm more prone to, again, play with the trend that price just came from. So I'll just play puts. Sometimes I may go against the currency and just play some lighter order sizes going against with calls. So guys, that pretty much wraps up our session on consolidation, on, you know, advanced ways to look at consolidation as well, down to the fundamental basic ways of looking at consolidation. If you have any questions, you know, first make sure, if you're not understanding it, if you're not grasping it, just rewatch the video, take notes, because we want you to take notes and we want you to internalize it. But if you have questions, that's what the chats are for. If you have questions, this is what mentorship is here for. We got your back, guys. Peace.